Hey everyone, welcome back to the channel. I'm Doug the Retirement Guy, and today we're going to find out who performed the best over the past 120 days. We're looking at the S&P 500 today. So we have Goldman Sachs GPIX, the NEOS SPYI, and the JPMorgan ROCY. It's kind of the newer fund out there. We're going to take a look at the yield, the growth, and the total returns to find out who is actually leading the pack over the past 4 months and who may be the leader in the next quarter. So grab your mug, fill it with your favorite beverage, sit back, relax, and let's go through who is the best S&P 500 over the last 120 days. First, guys, I got to do the disclosure. This is a presentation is for educational purposes only. This is not financial, legal, or tax advice. Past performances don't guarantee future results. Hey, if you don't have your favorite mug, well, you're missing out on, hey, this is our chance to help support the channel. We have an 11-ounce, 15-ounce mug. All you got to do is use the QR code or use the link down in the description below. Order yourself a mug. They are selling quick. And thank you. If you've ordered one, thank you so much. This does so much for the channel, makes things so much easier to produce these videos for you. Thank you so much. But if you don't have your Retirement Made Easy mugs, order them now. We'll get them shipped out immediately. So GPIX, SPYI, of course, those are pretty much, we've always said, our core products. Number one, number two, it gets tossed back and forth. NEOS is better than Goldman Sachs. Goldman Sachs better than NEOS. We're not here to argue that point. What we're saying is in the past 120 days, who was the one who basically produced the most for us? If you're looking for income, if you're looking for growth, I'm a guy who looks for total returns. So who's the winner across the board? So let's introduce the funds. The first one, Goldman Sachs S&P 500 Premium Income ETF, better known as GPIX. Now, Goldman Sachs does something unique. They have a targeted yield about 8.5% annually. They use a 92.4% return of capital. Now, what that is, that's their tax advantage. That's their tax strategy that they use is return of capital. So that 92% of the distributions are really coming to you as classified as your return of capital, your own capital money. So you're kicking the tax can down the road. Hopefully you're getting into the long-term capital gains at that point if you sell the fund. It does pay out monthly, and it does use what we call a partial call overlay. Now, the partial coverage allows for more upside room. This is probably the unique advantage to the Goldman Sachs side of it. It owns a portfolio designed to resemble the S&P 500 and then actively sells call options on a portion of it. Not necessarily 100% of the portfolio, which is where a mistake a lot of companies get into. Goldman Sachs basically has a program I call it a diversified spread, which is a 25 to 75% of the portfolio is covered at any one particular time. How do they make that decision? That decision is pretty much made by what is the market doing. If they see that the market has the potential for huge growth to taking off, they will lay back and only do 25% because they're going to capture more of that upside. If the market is getting choppy, volatile, they may go all the way up to 75% to generate more income across the board. So this thing's constantly changing. So that's why they can't really come to you and say, we do 62%, 70%. It's always different how the market goes. So the management adjusts the coverage based on that volatility, the market conditions, and the option premiums needed to support the distributions. So they're not just going to sit at 25% and let it go because they still have to hit that target at 8.5%. So not the highest yield in the group, but retains more upside participation than markets rise. So like I said, this is not going to be our biggest yield, but man, it's probably the best diversified fund across the board. Our next one. This is the next one that people will say, no, Doug, you're wrong. NEOS is always number one. Well, I'm a NEOS fan. I definitely like their products. But the SPYI, the NEOS S&P 500 High Income ETF, is definitely going to give you a higher distribution rate of 12.04%. And here's the other big one, the SEC yield. 0.47, which means over 11.5% of that ultimate yield is basically coming from the premium section. They're getting about 0.5% from interest and standard distributions. Now, the options that they use is the SPX index, and there's a reason for them doing that. So NEOS actually buys and builds a stock fund that resembles the S&P 500. Then what they do, they turn around and they buy SPX index options and sell call options on the index. Probably kind of unique. That's where that 0.5% basically comes into, is the growth of the particular stocks, and the dividends that they collect from that helps build up their yield. But then the SPX qualifies them into the 1256 contracts, which generally gives you a 60-40 long-term, short-term capital gain treatment of your distributions regarding how long you hold those funds. So this is how NEOS handles their tax side of things. So it's the most efficient tax program that's out there. So when you use this into a brokerage account, you definitely want to be looking at the NEOS packages because of the way they handle taxes. It's multifaceted. They use tax harvesting opportunities, which is basically selling a fund that is maybe down. They'll sell it off to use that as a tax harvesting program to reduce their taxes. The other thing they do, they still use ROC. They still use the return of capital. So you're getting basically 3 different mixes in that pot to get the thing handling your taxes. But more importantly, this thing's built for maximizing monthly cash flow. That actively managed strategy that sells those and purchases SPX index options gives the managers flexibility to shape the upside participation and downside exposure. So larger monthly cash flow while still keeping exposure to the S&P 500 appreciation. So it's a unique play they do it. It's kind of a different way than what Goldman Sachs does, and everyone said that this has been a very, very strong piece. I agree. Now, JPMorgan. JPMorgan, for you know, has been the leader for years. They had the JPI program that they had out there for their S&P 500. Well, this fund came out in March 18th of 2026. This is one of the newest funds that's been out there. ROCY, JP Morgan's Equity Premium Yield ETF, is using an old strategy with some fine-tune, basically I'll call it fixing the problems of their old funds and presenting it to the new funds. Distribution yield about 7.41%. Expense ratio 0.35, so extremely low on this point. As I said, it came out March 18th of 2026. And sneaker here, the last 3 months total return was over 11.09%. So what do? This is a call spread, not just plain covered calls. Okay, it combines an active selected portfolio of U.S. large cap stocks with option call spreads. One call and buying another at a higher strike. So let me explain exactly how, in my terms, my layman's terms, what we're going to say, and we're making up these numbers so you don't have to leave comments. Let's say they're going out there and they're going to sell partial of their large cap funds at $50. Okay, they're going to put the call out there at $50. And as the market's changing, they may turn around and say, "Hey, we're going to buy someone else's call. We're going to buy someone else's at $52." So the $50 one gets sold, but now they're at $52. So what they're doing is they're always trying to buy 1 ring, 2 rings up the ladder so that they can keep capturing more and more of the upside. So not only are they trying to sell their own, they're also selling other people's that they've bought. So the purchase call potentially lets the fund re-enter the market gains if the market makes unusual strong upward moves. So they don't want to cap the upside like happens with a lot of standard call options. You cap your market, you're not going any higher. These guys are constantly looking forward, saying, well, we can get another one here, we get another one here, and moving forward. What this gives us is the current yield, capital appreciation, total return with a lower volatility than the broad large cap market. It seeks tax deferred yield via return of capital, which is the big change in these funds that they are now using ROC, kind of why you see the ROC in the name and the ticker. They're using ROC to help generate the tax burden that they had problems with the JPI packages. So let's get into the comparison. Let's get into the head-to-head comparison. Let's see what's been going on in the past 120 days to see who is still our #1 champion. When it goes to income comparison, who paid the most cash? This is the big one. On this channel, I don't chase yields. I don't go after all that business. I'll look at yield, but I'm always concerned about the total returns because that tells us more about a fund. But over the past 120 days, we take a look at the numbers, and it's amazing how well these things have done. SPYI, the NEOS package, wins the income race at 4.25% over the past 120 days. So basically, a little over 1% per month. While GPIX and ROCY, both of them come in a respectable 3.11%. Okay, so it shows that SPYI's NEOS packages definitely can deliver higher income for people looking for the income package. Now, not only is it 4 percentage points, it's not just percentage points. Look at the dollars. GPIX came in at $1.56.5. ROCY came in at $1.55. How we do that? $1.55. So basically about a penny less than GPIX. But SPYI came in at $2.12. So we're talking almost 75 cents more than the other two funds in literally hardcore cash. So SPYI delivers the highest income. GPIX both are nearly tied. So the best choice if you're looking for an income focus for retirees, if it's all about income that you're talking about, SPYI definitely fits that bill as #1. Now, growth comparison. Now, I know we've talked about this when we get into retirement, that income is our #1 goal. We want that income. We want that money to pay those monthly bills and to live comfortably and to live off our dividends. But you always need some kind of growth along with it. That's why when we do the 3-bucket retirement plan, we have a growth bucket. Well, in the growth comparison, this changes the whole game plan. Which funds gained the most in price? Well, over the past 120 days, GPIX from Goldman Sachs is winning 11.74%. ROCY, JPMorgan, comes in at 10.61%. So basically about 1 percentage point below GPIX. Now, down 3.5 percentage points is SPYI at 8.23%. So the Goldman Sachs program captures more upside, which is that flexibility, that 25 to 75% package. It has more upside potential. ROCY came in a very, very close second, with SPY lagging behind because the return came from income. So you can see how the funds are really different. GPIX is built for good income, great growth. NEOS is built for great income with a good growth. And ROCY is kind of saying, hey guys, we're going to split you both in the middle. We're going to come into the good growth side of it. We're going to come with good income side of it, trying to play right in the middle of the two. So for growth people, GPIX is definitely the piece to use. Now when we get to total returns, and this is what I always say, total returns gives you the big picture across the board. Now the full picture, this is income plus your growth. Over the past 120 days, GPIX has actually outpaced everyone in the game. ROCY comes in a real close, about 1.1% down. So that's almost basically from the growth side of it. And SPYI has dropped again about 2.5 percentage points behind GPIX. So if you've invested $10,000 into the fund, you're basically looking, you'd have $11,486 if you're in Goldman Sachs, $11,248 if you were into NEOS, And if you're in JPMorgan, 11,372. So you can see the minor adjustments in 120 days, the minor adjustments, what those percentages actually come into place with. So does it make that GPIX is number 1 and ROCY 2 and SPYI is number 3? Has NEOS lost its championship role? Well, the key takeaways is this. GPIX finished first overall in total return because of the combination of income and growth. So if you're a person who's really needing more growth, okay, GPIX is there. If you need more income, you're not going to get that because you're going to have to sell funds to get your total return out of it. ROC placed second with a strong start. They're doing very well in their startup. And SPYI remains a solid, prioritized for income over application. So let's look at our scorecard to give you guys a little more insight of what's going on. The starting price at GPIX, $50.32, ended the period at $56.23, almost a $6 gain. SPYI went from $49.93 up to $54.04, again, about $5 gain. And ROCY went from $50.05 up to $55.36, again, another $5.31 gain there. So your price growth, 11%, 11.74, 8.23, and 10.67. You can see they're all right in line there. The distributions, again, bigger distributions from NEOS, higher total return out of GPIX. So the winners come down to this. If you're looking for income, SPYI is going to give you the most palatable income, and it's going to have some potential growth off of it, about 4% growth to about 4% income. Okay, GPIX is going to give you about an 8% growth with a 3% income. And so total return, again, as I said, it comes in the same game. ROCY is very good as a secondary piece. It doesn't have enough time yet onto it to give it really saying, hey, this is a core piece to play it, but very, very respectable numbers, very close to GPIX. So you have a lot of options to do here inside of these programs. So the question really comes in. So why did GPIX win? Well, GPIX didn't pay the largest distribution. It produced the strongest between income and market appreciation. Okay, SPYI's advantage is that it pays $114 more from a $10,000 investment over the past 120 days than GPIX. But GPIX basically outpriced SPYI by 3.5 percentage points. Okay, so that's enough to offset the difference between income and growth. That's why I said the total return winner really is GPIX. And it's because it's giving you more growth. It's capturing more of the upside of the market. So is this really what you want in retirement? Well, the question is this. Where does JPMorgan ROCY come into place? And we put it as a second place overall contender. And this is a strong new contender. So the equity premium ETF from JPMorgan, it's giving you good yield, 3.11%. It's giving you great growth, 10.61. It's giving you a total return of 13.72, very close to the GPIX. And it offers, I call that middle ground between the two. So the strong early performance, but it still has limited history. It's the only thing I have with this right now. Even though I give some credit to JPMorgan, knowing that they've done well with their other funds, there's been a lot of interest in this stuff, but it's still limited history. How is it all going to play together? How will it be? But it views as very, very promising, but still early with that track history. And I really put this, it offers that middle ground between SPYI and GPIX. So which fund fits your retirement goal? Well, this is how everyone starts talking to me. And why is it that when I talk to people, I do this on if you have my Patreon channel, we do this all the time where someone can buy 30 minutes to an hour conversation one-on-one, look at their portfolio, direct them to it. And so many people feel like they got to pick one or the other. It's a win or lose situation. And I've been trying to tell people over this, and I've helped a lot of people about this, is here's the unique thing. When you build to the 3 bucket system that I promote and I show and think it's best across the board for retirement, in the income bucket, you have a core piece. Well, what is your goal you want from core? If you want the biggest, most possible income aboard, SPYI is still your big ticket, is still your game. Now, you come up with what we call satellites, which are not core products. Cores you'll buy, you'll never probably sell, you just sit on it. But you need something as a satellite to help boost. Well, with SPYI, it needs a little bit of help in that growth section. So if you take and now put GPIX with SPYI and use GPIX as your satellite, you now have yourself a very strong returning piece with a bonus of income. So you got the cake and eating it too. You got income and growth, and you have SPYI as the bigger income. Now, a lot of people have said, well, I'll switch the two. Use GPIX as my core and SPYI as my booster from the satellite for income. Well, it's a unique way you can do that. ROCY is coming in to be that guy. They're coming in to be that fund that says, hey, you want to be SPYI? Buy ROCY and we'll give you the middle ground. We'll give you a boost in your income and we'll give you a boost in our growth side of it. GPIX, you want us to go over there? We can together, those two together can equal the income, the SPYI, plus big growth. So what you're doing here, it's not just pick one or the other. It's pick which one you want first and then have a satellite as number 2. And I've done this in the computer over and over and over with people, and I keep coming back with is you do GPIX and SPYI, they got long track history, they got some good history behind them. I'm comfortable across the board. Use them accordingly, and the difference between the two doesn't make that big of a difference if you're using them as core and a satellite. ROCY is the unique that's going to give us our third option to be able to do that same thing to it. So, again, which fund fits your retirement goal? Well, if you got to pick only one, if you're one of those, if you want income, it's SPYI. If you want the best overall, it's GPIX. You're going to reduce your income, but you're going to have bigger growth, bigger fun down the road, which always remember, bigger doesn't always matter. It's not always about how size of my income is or my portfolio is. It's how much income I'm getting that I can live off of. But I really think the third one is the real option. The most promising newcomer of ROCY, using that with either one of the SPYI or GPIX or a mixture of all three into a package. Let me know your thoughts below. What do you guys think of am I right or wrong? Is it pick one or none? Or is it to pick all 2 of them or 3 of them and mix them well into the bucket fund? Love to hear your input. Love to hear how you think we've rated these and seeing how the performance is done over the past 120 days. We've always done this where it's always been a full year, but that would leave out ROCY, and we really wanted to show you how well they're doing as well as the big boys. So my final verdict to you guys is simple. If you want income, pure point and blank, SPYI had won it. If you want growth, GPIX has won it. If you want total returns like myself, it's GPIX again. But man, ROCY, I'm very shocked at how well they've actually done in the first 120 days of being in existence in the fund, how well they're doing and running right up the middle and competing with the big boys right out of the gate. So to me, I think we learned a lot here today that ROCY is definitely a game changer, and it's given us strong 3 options in our income bucket. Hey guys, it's Doug the Retirement Guy. Let me know what you think in the comments below, and I appreciate if you bought a mug. Thank you so much. And if not, don't be afraid. Order a mug today. Enjoy it tomorrow. We'll catch you at the next video.